Hello, everyone. Welcome back to our live stream session. This time, I'm very happy to have Mark Walker of Tollymore here. Hello, Mark. How are you doing today?
Hi, Tillman. I'm really good. Thank you for inviting me.
You're located in London, or?
Yes, well, my offices are in London, but I actually kind of just moved my family out of London to a place called Kent, which is just outside, because we decided that a global pandemic wasn't really stressful enough for us. So we decided to kind of move house at the same time, spice things up a little bit. So I'm actually located in my house in Kent at the moment. But yeah, our offices are in the center of London.
So, Brexit is also a topic we should discuss during our live stream. And I also want to say hello to all the viewers. As always, you're welcome to drop your questions into the chat window so I can pick them up and post them to Mark during our live stream. Mark, before I show the disclaimer, I want to give you a question you can think some seconds about. The question is, what is a good investment for you? So you have some time to think about it. And for everyone else, you can, again, enjoy the disclaimer. You can find the disclaimer below in the link section. It says, the main message is, do your own work. This is no investment advice. We are doing a qualified talk, but you always have to do your own work. But that's also the interesting part. So without further ado, what is your answer, Mark?
Well, so first of all, Tillman, thanks again for asking me to have this conversation. I think that what you do is in the sort of clear spirit of intellectual generosity, but also, Tillman, I kind of I've had this kind of uneasy sense of embarrassment at being part of an industry that I've felt for quite a long time now has really just done a pretty bad job for its customers, which is the owners of capital. And what you and people like you are doing in a very value added way is to shine a light on those individuals, those investors, those managers, that community that are trying to forge a different path, which in many ways is kind of non-institutional. And they're trying to think carefully and thoughtfully about um, how to set themselves up to create value over time. And so this light that you're shining on them and the sort of support that you're giving them is very, very invaluable because there are lots of kind of barriers to uh, small, thoughtful managers becoming sustainable. So I just want to kind of thank you on behalf of the community for that work that you're doing.
Thank you as well for coming on and sharing your insights and your wisdom.
So what makes a good investment is like a huge, huge question. I guess that I think that it's helpful to understand what Tollymore's central philosophy is. It's also instructive at the outset to clarify that I don't think that there's anything unique or exotic about this philosophy, and I certainly don't consider it a source of edge. It's a philosophy that has, I guess, kind of three principles. One is that we're trying to exploit a time arbitrage over time in the public markets, with the goal of a very simple goal of maximizing the intrinsic value of a group of assets over a long period of time. And what that typically involves, and the reason that that is through a mechanism of public equity investing rather than private business ownership, is that we can buy securities from sellers who are selling for non-fundamental reasons, because they have not set themselves up. They don't have an ecosystem that's consistent with executing a long-term strategy. And the obvious examples might be because they have misaligned LPs, or they have short investment horizons because of all manner of sort of constraints on their ability to make good decisions. And so we want to buy the securities from those people. Now, secondly, the implementation of that philosophy, that goal of maximizing intrinsic value of a group of companies, is predominantly through ownership of companies that can compound their own values through their own efforts over the long run. And that necessitates a kind of level of self-awareness and recognition that we might not be that great at actually managing a portfolio, but if we can pick the businesses that can do the work for us, that is a less labor intensive and more efficacious route to a good outcome. And then thirdly, the third aspect of our philosophy is, if our goal is to maximize intrinsic value of a group of companies, if our goal is to be in this IRR Hall of Fame, then it's absolutely imperative that we understand and cater for how we permanently lose money. And so there's a risk framework that informs what we are and what we are not, and that is, from two angles. We consider permanent loss of capital to be a potential outcome. One is through the holding companies themselves, and we look for businesses that have a number of lasting unfair advantages. That is, that they can protect and hopefully grow their enterprise value over time. Secondly, we look for those companies who are appropriately capitalized so that intrinsic value growth over time accrues to owners rather than lenders. And then finally, we're trying to acquire those businesses at prices, which means that our IRR as an equity owner of the business is at least as good as the intrinsic value compounding of the company. So that's the overall philosophy. But as we might discuss, my kind of experience to date has led me to believe that there's a sort of lollapalooza of institutional constraints to just simply executing that philosophy, even if the rhetoric of long-term investing is well understood and well versed. So this idea of business quality, I think, often comes. You ask what makes for the best investments. Well, we've made a distinction over time in obvious versus non-obvious business excellence, and frankly, we've done a pretty poor job of generating acceptable results by investing in obvious excellence, principally because that excellence is generally reflected in asset prices. And so what I find is that it's often these kind of multiple small mispriced insights that over time compound to form a business which is very defensible and very difficult to replicate. And the discovery of those multiple small insights really requires a bottom-up, organic, idiosyncratic investment process. And those opportunities are really what is missed by some sort of some investors who label themselves as quality managers, because they are inappropriately attaching labels such as network effects or platforms or recurring revenues or SaaS or working from home stocks or whatever the heuristic of the day might be. And so what's really crucial to us in unearthing these non-obvious moats is a first principles approach to understanding business characteristics and unit economics, and the description in a first principles way in our research, which leads us to a conclusion of whether or not this business is high or low quality along the vectors we use to define that. And that is much broader than simply competitive positioning, for example.
You mentioned the word long-term. How do you use it in your practical approach in investing? What is long-term for you?
Yeah, so I think that, one of the things I talked about was that we have a risk framework which means that long-term is a risk mitigant, because it allows us to focus on those businesses that are very high quality and be reasonably agnostic as to over which period of time the value is created, and we can be very patient long-term holders of companies to realize that value. One implication of that, for example, is we don't short securities. I think that having an unlimited downside and capped upside is inconsistent with our ability our willingness to take a view, which in some cases is very well beyond 5 years. I think if you're a short seller and you consider that your business is worth zero effectively, then really that you need to be right on a horizon which is shorter than 5 years if you're willing to accept an opportunity cost of capital, which we're willing to accept. And in fact, if Tollymore's historical results are your opportunity cost, then that's much shorter. And if you're trying to achieve an outcome which is 50% lower than the current price, then again your horizon maybe turns into 18 or 24 months. And to us, that is a very labor intensive, hard thing to do. So we've learned over time to try not to disrupt the positive fundamental business progress of the companies that we own. And that's also then informed the source of capital that we've used to average down in businesses whose quoted prices aren't doing so well over time.
What is the history of Tollymore, and what's the meaning of the castle you have behind you?
Yeah, Tollymore is just so I grew up in Belfast in Northern Ireland, and Tollymore is a forest that we as a family, my sort of extended family, spent a lot of time growing up in, and it's a really kind of beautiful place. It's the foot of the Mourne Mountains in Northern Ireland and overlooks the Irish Sea. And it's a place that is kind of tip of the hat from me to my heritage, and it's something that holds like very happy memories for me. There's no real kind of clever association with the business of investment management.
Doesn't need to be there. You had a good performance till 2020. When I looked in your fact sheets and letters, I saw this performance. This was good, but in 2020 your performance went even better. What happened for you this year?
Yeah, so while being very cognizant of trying to extrapolate or interpret short-term results in this way, I'd say that 2020 has been a really important year for Tollymore, because our investors, what they're doing is they are underwriting my business judgment, and they're underwriting my investment judgment, but they are fully aware that the business of investing, the process of investment learning is never finished. We are on a treadmill forever, hopefully forever, as long as our mental and physical capacity allows us to do so. And so this was a period of like rapid learning, I think, for a lot of people. And it's while Tollymore has had a consistent investment philosophy and a process that helps us to govern our behavior on a day-to-day basis in a manner which is consistent with that philosophy. I'm kind of very aware that that is something that needs to evolve over time, and the investment decisions that we've made over time have evolved, and the sources of investment results have evolved over time. So some examples, I think that earlier this year was the most volatile market in history, and it was a really comforting, clearly it was quite a stressful time, but a really comforting time for me, because I've worked quite hard over the last few years for Tollymore to be one of these very defensible, non-replicable, anti-fragile businesses in which I seek to invest over time. And some of the ways that I've sought to do that is to think about incentives within Tollymore, think about the components of Tollymore's ecosystem, which includes the physical working environment, includes the working partners that we involve ourselves with, and it includes our investment partners, our LPs. And so, I've tried to create a set of LPs who are very temperamentally aligned with the objectives. They are, very unconventional by the standards of institutional active asset management, and they are they have the capacity to certainly think and hopefully act in a counter-cyclical way. Now, when I talked before about an investment philosophy not being exotic or unique, but what I've observed in my more institutional experience prior to Tollymore is that there are so many constraints in large institutional active money managers, whether that is like the imperative to grow assets, whether that is the division of labor between portfolio managers and analysts, whether that is specialization according to sectors or geographies, whether that is internal incentives and bonus structures, whether that is lack of insider ownership, whether that is misaligned LP base. There's just so many that prohibit this the ability to make sensible decisions. And one example is that in the face of quoted price volatility, can we as fund managers, have we set ourselves up, do we have an ecosystem that allows us to either acknowledge our ignorance and the fact that we actually don't know what we think we know about this investment opportunity, or does it allow us to recognize that we do know and that the quoted price decline presents an opportunity to improve our IRR by lowering our cost basis, and we can exercise conviction. So in March and April this year, as you might imagine, Tollymore, we didn't need, frankly, to look outside of the portfolio for distress investment opportunities because there were plenty within the portfolio from which to pick. And some of our businesses were down 65, 70, 75% in a period of 4 to 5 weeks. And what was a huge source of comfort to me was that our capacity is appropriate for the strategy. This is a capacity constraint mandate. Our investment partners are willing and able to think counter-cyclically and able to not only not redeem, but to step up to the plate and lean in. And so what I realized was a real shame of asset managers is that when they bend to the overwhelming incentive to grow assets in an incredibly scalable business model, what that leads to is when we have these retrospectively seem like these gifts, these opportunities to acquire businesses at lower prices, they are constrained from doing so for non-fundamental reasons because of liquidity or because they can't be a certain size of a company. And when you have a portfolio, the positions in which are dictated by non-fundamental reasons outside of simply investment merits, you're doing a disservice to your investment partners. So that was kind of very instructive. I'd say this, one of the other ways in which the portfolio has evolved is that some of the biggest holdings in the portfolio are there for different reasons. Like one is there because we aggressively averaged down in this period. Another is there because it is just done very, very well. And Tollymore is a concentrated portfolio and has a global remit. I think the natural implication of that is that we are a fully invested mandate, and that's great for me because frankly I am unable and therefore unwilling to use cash as a mechanism to time markets, and I don't have to because of a small portfolio of assets and a big opportunity set. But what it means is that when it comes to averaging down into certain businesses, we don't have cash with which to fund that activity. And so we need to decide between essentially cutting our winners or cutting our losers. And I think increasingly we've been more comfortable with avoiding the disruption of fundamental business progress of the companies that frankly deserve to be larger portions of our portfolio, and forcing us to choose between the losing investments that are eroding value, those that deserve our capital and those that don't. So I think that some of the businesses have done very well. Some of the businesses are still 50-60% off their previous prices from the start of the year, and they remain very core positions for us.
That's an interesting insight. You're investing globally, and this is a bit of a challenge to boil down to the best ideas. Like, what are your steps to boil down to the good businesses and the anti-fragile business you mentioned?
Yeah. So, the opportunity set is global. We're not global investors in the sense that we are trying to identify thematic changes or geographic opportunities from a top-down level and using that as a source of idea generation. As I said before, I think that for us, it's just really important that opportunities are discovered in a way that some might consider haphazard, and because it is very serendipitous in nature. And what we're not doing is finding ideas according to a systematic, quantitative way, such as screening. And one of the reasons I've described, and it's that if you're looking for these businesses that are high quality according to our vectors of quality, and you're screening for such over a period of time, then what you're finding is obvious excellence, and that is unlikely to be undervalued. But then more broadly, the problem that we have with screens is that those who use screens cynically, coming back to this imperative to raise capital, I think are doing so partly to make the investment merits of their organization more marketable in an institutional sense. Institutional investors are typically, and rightly so, trying to understand the repeatability of a process to allow them to underwrite it. And it seems that by showing a kind of quantitative or proprietary idea generation funnel, you're helping allocators of capital to tick that box of repeatability. Now, like, our process is serendipitous in nature, and it's really driven by energetic and passionate engagement with written and verbal materials and conversations with management and our peers, and engagement with reports and transcripts and filings, and if that is energetic and it is a highly motivated endeavor, and if you're passionate and if you're reasonably competent, it's a perfectly adequate way to uncover investment opportunities. And our issue has never really been that a dearth of investment ideas. What we are trying to do, what we think is repeatable, what should be repeatable, is the judgment with which you interrogate that idea. And that again comes down to what your incentives are, and how you're resourcing the investment process. And are you resourcing the investment process with a large, highly pedigreed investment team because that is the way you raise assets? Or are you resourcing it in a way that is most efficacious and likely to do the greatest good for your existing cohort of investors? People in the industry where I have a debate over the merits of screening, will suggest that screens will, just simply by fishing in that pond, do you improve your chances of success because that pond will outperform in itself. And my argument is that it may well have done so in the past, but there's no real guarantees that it will continue to do so in the future, particularly when the screen is predicated on any kind of style factor type of investing, such as growth or GARP or value, as value is typically understood, especially considering the sort of changing business models of the future versus the past. And then, if you look at our portfolio, there's a lot of companies that screen really badly there, and some of our largest positions screen really badly. And that's because the reported financials of the business poorly reflect the economic reality or economic prospects of the company because of accounting convention, or because of businesses in transition, or simply because of high levels of internal reinvestment opportunities. And so we attempt to sort of disaggregate between owner earnings and reported free cash flow, for example.
What makes you kill an idea? And what makes you like or love a company that you want to hold it for years?
Yeah, so we have the bar is high in that we have a research process which gathers hopefully objective information, data, strands of logic, which are designed to support or refute a contention that a certain vector of quality is high or low. And so these are not proprietary or rocket science. A lot of them can really be found in Hagstrom's The Warren Buffett Way, right? It's like, is this business simple? Is it appropriately financed? Is the stewardship adequate or good? Is the competitive positioning of the business strong? Does it have avenues for internal redeployment at very value accretive rates of return? And so we are collecting this information and trying to score in a pretty unquantitative but very qualitative way whether we think this is a high quality business along these vectors. An idea will be killed if it becomes clear that this is not a high quality business along these vectors. But if it passes those hurdles, and I'm very excited about the quality of the company and its prospects for internal capital and the excellence of its stewardship, etc., then we will assess the valuation from multiple angles, but oftentimes through a lens of a sort of prospective IRR to equity owners, which starts with an understanding of what the owner earnings yield of the business is and what the reinvestment rate and the incremental returns likely to earn. And that triangulation helps us to gauge a rough whether the IRR is really high or really low, for example. So if we get this business that is screening to be a very exceptionally high IRR, that may be because of the reason I talked about before, which is that these cumulative mispriced insights are adding up to a business quality and opportunity that is like substantially undervalued.
Interesting. How are you aligned with your investors?
Yeah, so I think that Richard Lawrence of Overlook has this, this phrase he refers to as outlawing greed, which is a major competitive advantage in this industry, but a path not really taken. And I think that if you can set up a set of investor incentives that allow you to outlaw greed and focus on returns above asset growth, you've taken a large step of the way there. And so the way in which we've kind of thought about that is to be very rigorous and disciplined about the investment partners that we take on. We want a very small number of partners over time. I think everybody talks about the value of relationships in life, but rarely actually implements that understanding and sacrifices it a lot of the time for rapid wealth accumulation, and then wonders why they're sort of not happy given that sacrifice they've made. We have, the majority of my capital is invested alongside investment partners. Currently, Tollymore's economics for me imply that I will accumulate more capital from the compounding of my ownership of funds under management than from any fees that Tollymore is paying me. And then we have a set of fee structures that have been sort of stress tested under a range of scenarios to ensure that under reasonable circumstances, investors receive not just a majority of the return over time, but a majority of the alpha over time, a majority of the excess return over whatever reasonable benchmark they may decide. And we have different fee structures, with some with fixed hurdles and some with benchmark hurdles that investors have chosen. And so if you kind of look at our cumulative results to date, investors have received around almost 3/4 of the excess return over the benchmark over time. And then this is one of the one of the things I've been thinking about more since the sort of March and April period of 2020 is really what is the appropriate capacity of the strategy. And again, one of the ways to engender alignment is that you err on the side of caution and you close the capacity of your strategy comfortably below what you think the ultimate capacity of the strategy is. And it's our intention to close the capacity to external investors, and then to periodically allow existing investment partners to add if and when appropriate, if we have other periods of severe dislocation like March and April.
We have a first question coming from the chat. If there are more questions, please type them in. The question is, if you invest in businesses in the process of building a moat, but not there yet, for pre-moat companies, historical numbers that you find in a screen look chunky, but the future could be very bright. What is your take on this question?
Yeah, I think it's completely consistent with what I was saying about obvious and non-obvious excellence. So if I look at the contributors to Tollymore's results and the detractors from Tollymore's results, the major contributors are from businesses which at first sight are written off as low quality businesses. And that is due to usually a faulty heuristic and an inability or unwillingness to interrogate the business quality from first principles. So for example, investors have written off Trupanion as an insurance company. The heuristic associated with insurance companies is that they are capital intensive, stodgy, mature businesses with limited opportunities to internally redeploy capital and constrained addressable markets. And I think that heuristic has led to a really outsized investment opportunity. And really, if you think about the components of that company's value chain and how they cumulatively manifest in this really phenomenal business, then you can kind of avoid that heuristic. Likewise, one of our largest holding, Gym Group, is a old economy, operationally geared, financially leveraged business selling discretionary services with very high churn in a world in which is enamored with high multiple of sales SaaS companies and big tech. And so if you could succumb to being a victim of this sort of potential bubble in buzzwords by becoming overly enamored with these labels, if you're not interrogating from first principles what a good business is and what a poor business is. So those types of opportunity have contributed strongly. Then what we've done badly in two main areas. One is where we've identified obvious excellence and we've become enamored by this beautiful financial history going back 10, 20, 30 years of extraordinary consistent supernormal profit generation. And the second area is in what's often called legacy moat type companies. So back to our goal is to maximize the intrinsic value of a group of assets. There's really two ways of doing it. One is that you buy assets at very strong discounts to current intrinsic value. That necessitates a re-rating of the asset or a turnaround of its fundamental prospects. And potentially that re-rating needs to be accompanied by a catalyst. And that's a very labor-intensive method of generating acceptable results. When you're trying to identify catalysts, I think that those catalysts are readily identifiable to most people, and therefore it's unlikely that there's this big gap between price and value, or big gap between future likely results and expectations. And so we've been poor at picking those deeply discounted legacy moat businesses, despite our contention at the time that they were extraordinarily discounted. And by the way, we're not investing in businesses that fail to meet our objective qualitative criteria for quality. These are all extremely high quality businesses, but they generally have limited opportunities to reinvest capital and internally grow their own assets. So over time, the results have been more and more driven by these businesses that at first sight, to the questioner's question, don't have a moat which is widening, but is not obviously huge, because they can't, there's no eloquent way of describing it, because it's not an economy of scale, or it's not a switching cost, or whatever moat label you wish to use.
You already mentioned two names, Trupanion and Gym Group. Can you tell us a bit more why you like these companies and are invested in both? And also how you manage your feelings, because on the one side, Trupanion is a huge winner in this year as well, and Gym Group is getting squeezed and is one of the COVID losers, if you could call it like that.
Yeah.
But how do you manage to stick to both, and how do you manage the loss on the winner side?
Yeah, look, I think that I think that so Gym is a business that is a large position because we bought a lot more, and it's my view that our final purchases in March and April, I think, were purchased at IRRs of 60-70% and like owner earnings yields of 35 to 40%. It's a good even like pre-COVID, Gym is a good example of this kind of very serendipitous idea generation process, and it was really discovered initially as a consumer experience where having been a member of a mid-tier large multi-site gym in the UK for a decade, I suddenly started seeing that mid-tier gym sites closing down, and then these low-cost gyms from Gym Group and a business called Pure Gym opening up sites increasingly. And when I just kind of looked very roughly at the profitability profile of these mid-tier private equity, mid-tier owned gyms and the low-cost gyms, it was very striking that these low-cost gyms were just incredibly more profitable. Their supernormal profits were kind of off the charts compared to mid-tier gyms, but their prices were 60 to 70% lower. And having joined those gyms, it became clear to me that it was actually a superior proposition. It was a more enjoyable experience. And the question then becomes, as a potential business owner, is this sustainable? And I think that if you think about the positioning of the incumbent in this industry, what can the mid-tier gyms do? Well, it was my view that looking at their margin profile, that they could cut their prices 10, 15% before they become loss-making at an EBITDA level in a capital-intensive industry. And so their competitive response has been really muted. Like, there've been some small efforts to launch low-cost alternatives that have been quickly wound down. And the source of the low-cost gyms' supernormal profits is, there's a margin superiority which is a function of lower labor intensity, because there's only 1 or 2 employees per gym, and there's an asset turn advantage which is facilitated by a few things. One is that they don't have any wet facilities, so they don't have any saunas or steam rooms or swimming pools. They don't have any general coffee or greeting areas, which improves the density of their site usage. Their site utilization is improved. The other factor that improves their asset turns is because of the low labor intensity and the technological tools they're using to admit people into the gym, they can open 24/7. So their assets are used more efficiently. That is also a 24/7 capability is also expanding the addressable market to those gym users who are previously they're shift workers or taxi drivers, or they previously didn't have access to gyms that had constrained opening hours. they also address the other barriers to gym participation, which are around cost. People not being able to afford to pay 40 or 50 pounds a month for a gym, and contracts. And people are not signed into contracts with low cost. So it's kind of my view in a nutshell that this is a business with very, very high owner earnings as a percentage of its market cap that were substantially all being reinvested in projects that I felt were earning 20% plus cash and cash returns on capital. So there's a kind of, so in this sort of this investment universe, these are unconventional sources of a company's competitive advantage. But Gym is also a really good example of a business that is almost the holy grail of public equity ownership, because it's a business that has been steadily compounding its economic value and its owner earnings over time. But there's a very volatile public equity associated with it. So since our ownership, it's basically doubled and halved, doubled, and now it's kind of like 60% below again. So it's below our original cost. But it has contributed positively to our cumulative results, because our average purchase price is lower than our cost price, and we've owned it's been larger position in the portfolio when the stock has been beaten up. And it presented a great opportunity in March and April, because in many ways the market very efficiently and aggressively recognized the shortcomings of this business model in a world where people are instructed not to leave their house, and a world where governments are telling gyms to close down. So it's a business whose revenues literally go to zero. They're not selling discretionary services. They're not selling services with any kind of pent-up demand phenomenon, and they have a very high fixed cost base. But it really, it took some sort of back of the envelope additional work to re-underwrite our ownership of the company through a lens of liquidity first. And, my view was that this was a business that was just absolutely not going out of business. And actually their capacity to flourish at the other side of this is really, really attractive. I think that for a number of reasons. One is that their relationship with their landlords is likely to improve because of the dearth of retail or restaurants seeking leases. The other is that most gyms are either local authority gyms owned by the government, who have been heavily subsidizing them and now face a funding crisis, or they are mom and pop, fragmented, highly levered single sites with weaker relationships with real estate landlords. And then finally, the recessionary or cautionary conditions that COVID is and is likely to continue to confer could well accelerate this migration to low cost gyms that don't tie people into contracts. So in a nutshell, you've got this capital cycle potential outcome where capacity is exiting and demand is increasing. And if you believe that they have the liquidity and the balance sheet to survive a period of extended lockdowns, then back to your, one of your earlier questions about what is the long term. Well, this is a classic time arbitrage opportunity where their results are likely to look pretty horrible for a while, but they're, to my mind, they're now the best capitalized player in the industry, and their prospects for incremental returns on capital have probably actually gone up over time. I'll sort of pause there without diving into Trupanion, but in case you have any questions, or I can talk about Trupanion.
There were two questions coming up. One is, if you see, I think you answered it already a bit, Gym Group as the winner in the post-COVID world, and if you see any other winners in the fitness space as well. And also another question that was coming up is if people's habits change. So people get used to train outside the gym, and after COVID, there's a high chance that they won't come back to gyms. So this might be a problem for Gym Group.
Yeah. So, Yeah, other winners are basically, I think, the other main low-cost operator, which is Pure Gym, which is a private business. I think that you may well have this sort of barbell evolution where there's low cost and then there's sort of premium gyms where people really, really want that swimming pool or that tennis court or that boxing ring. And I think that there's potential parallels to be drawn with low cost airlines or supermarkets where these propositions are initially low cost and then they simply become the mainstream. I think that the proposition gap between mid-tier and low cost is so substantial that the market share opportunity is very clear. And as I said before, there's a market share opportunity driving volume, and then there's also an addressable market expansion opportunity driving volume. A third of customers every year, new customers for gym and Pure Gym, have never used the gym before because they're addressing these barriers to entry. That kind of addresses a little bit this challenge of a structural change where people sort of like train at home. But I'll come back to that. So the other winner is, I think, is likely to be Pure Gym, and what you've seen is Pure Gym and Gym are really accounting for the vast majority of new gyms and new members in the UK. The evidence so far since gyms have opened is that very quickly gym memberships and visitors are returning to almost pre-COVID levels. I think that I'm more comfortable betting on things that are likely to remain reasonably unchanged rather than calling an inflection and a structural inflection in human behavior. I think that Jim's share price reflects either an anticipation that the business will not survive and lacks the liquidity. I think that's absolutely very comfortably refutable. Or that people just aren't going to visit gyms anymore. I think the evidence so far does not support that, and I think that is I think the logic also doesn't support it. I think that as a user, my experience I think has been pretty consistent with other people's experience when gyms close down, which is that I kind of switched to an app, which by the way was offered in partnership with Gym Group, and I used that app to try to train at home. And at the start, I was very enamored with the experience. I thought it was like a very high production quality experience. But after sort of 3 or 4 weeks, despite having this huge library of exercise classes and different trainers and so forth, I basically sort of became a bit bored. And unless you have the capital and the space and the time and the willingness to set up a fully functioning gym with all manner of equipment, and unless you're permanently willing to forgo the social experience involved in training with other people and using that as a source of inspiration, I think it's unlikely that people don't return to gyms. I mean, potentially, the addressable market doesn't grow as quickly as it was growing before. But I think for the reasons I've articulated, that the market share opportunity is larger than it was before. And so I think you have a future in which Jim's competitors are very distressed. You've seen that in high profile bankruptcies over the globe. And in some cases you've seen businesses, low cost business models in continental Europe, such as McFit, acquiring those assets. I think Gym Group, as the best capitalized business in this sector, certainly has on its radar opportunities to acquire those businesses. It also has on its radar potential premium site acquisitions that were previously not meeting its return on invested capital hurdles, but now because of the sort of real estate situation will be able to contribute to profitable site growth.
I think there's also a certain desire to go back out again after COVID is over, because everybody is frustrated being home.
Yeah. I mean, it's just the value of having a long-term lens, and in this case, I don't even need to think it's a long-term. It needs to be that long-term, right? If you just think, what is the likelihood that in another 18 months, Jim is not somewhere around its previous level of utilization and unit economics, if not in a better position. And the business is today, sort of 25% owner earnings yield, reinvesting all of that at 20% returns on capital.
Interesting opportunity. Should we switch to Trupanion?
Sure. I think that.
What do you like about the company? And I still have the question open: is it easier to keep a loser or to keep the winner?
So, with my temperament is such that I've been historically very comfortable averaging down into situations where I felt that the opportunity to improve my investors' investment results presented itself, and I've had mixed success in doing that. And sometimes I've been guilty of being the sort of proverbial boiling frog and being very slow to recognize structural deterioration, either structural deterioration in the business or my ignorance or misunderstanding of the business's prospects over time. So I'm trying to kind of be more cautious and slower to average down. I do think that Jim was just a really exceptional opportunity to do that in March and April. I've also, the corollary of that is that I've been slower to cut profitable investments if those companies are demonstrating a level of execution and fundamental economic earnings progress that justifies that. I think that, with Trupanion, we have lowered our position size. I think that when we first acquired the shares a couple of years ago, this was really a business that I felt was valued to not grow, and I felt that the growth opportunity was extraordinary. Today, since in the last couple of years, essentially the stock has tripled. Now the owner earnings of the business have also compounded quite strongly, but the current multiple of stockholder equity implies a sustainable growth rate of sort of 7 or 8%. So while that re-rating of the stock will typically not cause us to exit investments, but it may be a trigger to very occasionally and sensibly pare back our ownership if the owner earnings yield decline is a reason for the lower prospective IRR. So just to kind of to kind of go back and use Trupanion as an example of what some of the things we've talked about today. Trupanion basically offers medical insurance to pets, to cats and dogs in North America. And as I said before, if you kind of apply, if you're a business quality investor and you apply this sort of heuristic that insurance companies are low quality generally, and they should be valued at sort of low single-digit multiples of book, then you'll quickly, as a long-only investor, you'll quickly dispense of this as a potential opportunity. And if you are a long-short manager, you might be very interested in this business as a short. And I think that Trupanion is one of the most shorted companies we own. It's less now, but it still has a very high short interest now. I've described the reasons why we don't short securities, but I think it's useful to understand the short seller agenda that I described earlier, to examine the insights that we believe we have about a company. And now I think that I'll sort of take you through like the points of contention that bears on this company have, and why we think that through our lens as a very long-term, long-only investor, they don't really make sense to us. I'm kind of cognizant of the behavioral risks associated with what I'm about to do, in being like, it's not my business to be overly defensive and get into arguments about whether a company is investable or not. But when you kind of understand the reasons for the short interest in the business, and you disagree through a research process, which is bottom up and hopefully objective in nature, then it can lend some conviction to your view, which allows you to know what to do when the quote price changes. So one of the things that it's been argued by people who dislike Trupanion as an investment is that the provision of medical insurance to cats and dogs, which is distributed via vets, has endemic to it an adverse selection issue. And that is that if you're selling to animals in the vet, you're selling to sick animals, and that affects your risk pool, and that will cause a rate spiral, and that will cause an affordability issue for your customers. Now, Trupanion is really the sort of only pet insurance operator distributing its insurance via vet relationships. And other competitors to Trupanion rely more readily on online marketing to acquire customers. It strikes me as logical that if you are Googling for pet insurance, then there may well be something wrong with your pet if that's your first interaction with an insurance product. Whereas if you, like Trupanion, are focused on puppies and kittens, that is, animals in the very early stages of their life when they first visit the pet in the first few months of their existence, I think that your propensity to have an adverse selection problem is much lower. One of the other issues, again, in this world where net retention ratios of comfortably above 100% seem to be the holy grail of investing in sustainable enterprises. A business that has an implied churn of sort of 16-17% a year seems like a low quality business with a customer retention problem, which increases the cost of doing business. So Trupanion expresses its churn on a monthly basis, which is sort of 98-99%. This implies this sort of annual churn of around 17%. Now, that can really be explained, it seems, by two phenomena. And one is that the customers who churn early, which is most of the churn, are those that are under the misperception that pre-existing conditions are covered. And once they realize that there's no coverage for such pre-existing conditions, they churn off. Now, clearly that's an opportunity for Trupanion, and they can do better in educating their customers about that lack of coverage. But normalizing for that factor, you have a churn level that is then predominantly explained by the average life of a pet. So I generally think that Trupanion is given its business model, does a reasonable job of keeping its customers. Like Jim, actually Trupanion is this holy grail of investing in many ways, because it is a business demonstrating very consistent, strong, positive, fundamental progress, but whose quoted equity is extremely volatile. The Trupanion has never reported a quarter of revenues that was not higher than the previous quarter in its sort of like 10 years of financials. And that isn't because they have phenomenal executors in a challenging business. It's just the result of a recurring revenue model and a very high and underpenetrated addressable market. I think that the last bone of contention for short sellers is that it's sort of like two-pronged. One is that, the management, the CEO and founder of Trupanion is overly promotional and disingenuous in his characterization of the business and how it makes money, and how they think about allocating capital internally. And I've sort of specifically read bear arguments that contend that the CEO has compared Trupanion to SaaS business models in order to try and get this very high SaaS multiple. And I haven't seen that anywhere. What I have seen is that in his shareholder letters, he specifically said that this is not like a SaaS company because it has a high cost of doing business. It has a high cost of sales and a low gross margin. But he has used comparisons to companies like Netflix because the recurring revenue element, and because the growth of its key assets is around 30% and its gross margins are both around 30%. But I don't think that because he's not describing this business in sort of traditional insurance terms, I don't think that his characterization is disingenuous. And then that kind of leads to where we are in valuation, which you've mentioned before, which is that, if you have a heuristic that this is an ex-growth insurance company, then you will be very excited about potentially shorting this company. But as I described before, I think that despite quite a strong re-rating of the asset, it's pricing in a level of growth of 7 or 8% sustainably, because on an owner earnings basis, that is, if Trupanion stopped reinvesting internally to acquire new pets, the ROE of this business would be in the order of 40 or 50%. And what it's doing with all of those owner earnings is directing them to invest in new pets with investment returns which are 4 to 5x any reasonable opportunity cost of investing. So that's sort of the reasons why that it remains this kind of core investment for us.
That are good rates, for sure. There's another question from the chat. Do you expect a consolidation of certain industries after COVID? It's a more broad question, but referring to Jim,
yeah, I think that we don't really think in this kind of thematic way of let's think thematically about COVID or the US election or Brexit and carve out winners and losers and try and invest according to those paradigms. But yeah, specifically with Jim, as I've outlined, I think that it makes sense that a number of competitors are not going to be in great shape to compete. Like the local authority gyms, around 35-40% of them still haven't reopened. Those gyms are charging sort of 40 pounds a month. Gym is charging 18 pounds a month, and reinvesting substantially in their gyms. So I think that value proposition is going to maintain. And as I said, I think that it's very reasonable that capacity will exit and demand will continue to increase. I think that on the broader point, I mean, you kind of mentioned Brexit before as well, and I have no special insight into inferring consequences of macroeconomic or geopolitical events. I think that what this year has shown, as reiterated, is that it is unknown unknowns that in aggregate move markets, and unknown unknowns are impossible to forecast. Then when it comes to known unknowns, I think that the market generally does a reasonable job of pricing expectations in an aggregate way. And therefore, I think that trying to predict the future, trying to predict the evolution of known unknowns is also a low ROI exercise. So it comes back to well, what can you do? And I think that all you can really do is own these companies that you think have business resilience and are led by adaptable, innovative managers and owners to lead through crises. One of the things actually that we look for and talk about or recognize in some of the companies we own, and Trupanion's a good example as well, is like symbiotic value chains. So I've been quite like dismissive of most ESG programs and the value that really can be created by the quantification of an ESG checklist and the employment of consultants to help formulate ESG checklists. And really the business of investing, business of long-term sustainable investing, should satisfy a reasonable ESG agenda. And one of the ways to do that is through a symbiotic value chain. It's through a shared mission which goes beyond profit maximization. And the ironic consequence of that shared mission, if customers, if employees, if owners of the company are united in a shared objective, the ironic consequence is usually profit maximization over a long period of time. And so, there's something, the sort of microeconomic examination of Trupanion's value chain is an interesting insight in itself. Like if you consider, what a 70% loss ratio implies for the customer proposition, well, it implies that the customer is paying a 43% markup on every dollar of premium. The customer seeking an ROI on this is going to find that very uncompelling. But of course, customers are not seeking an ROI. They don't want their pets to be sick or unhealthy. And there is an asymmetry in the value chain that is as follows, right? Customers are not pet owners. They don't have access to the aggregate information of an insurance company that the insurance company is using to accurately underwrite policies. Now, even if they do, so that is a barrier to self-funding the medical requirements of their pets. Now, even if they had access to that aggregate information, they still don't know if their pet is on the lucky or unlucky side of that distribution. And they so the value of a 43% markup is actually very high to them. And by the way, Trupanion's competitors have 50% loss ratios, so their 100% markups are even less compelling as a value proposition. Now, there are other components to the value chain that, again, I think compound to form what is a very resilient and anti-fragile business. And one of them is that the founder, Darryl Rawlings, has a very transparently communicated formula for sharing enterprise value growth between employees and owners of the company. And by the way, all of the employees are owners of the company, and lots of the employees are customers of the company because they basically all own pets as well. And so that's a form of symbiosis. And then finally, Trupanion has this software product called Trupanion Express, and that is installed in a number of their vet partners, and that allows Trupanion to directly pay claims within minutes or seconds of a claim being made. Now, this is a really interesting development, and because to me it really cements this idea of symbiosis. It really cements this idea of win-win-win. This is a great evolution for Trupanion, because it allows them to have access to data from other insurance policies provided by other insurers. That allows them to more accurately price their products. It's great for the vet because the vet can suggest and implement plan A treatment options, and it reduces economic euthanasia, which is sometimes a function of the customer's inability to fund out-of-pocket expenses. And also for the vet, there's a direct financial impact, which is the credit card fees are saved, which can be 15 or 20% of their profits. But it's also interesting to understand their vets are very, their careers are intrinsically motivated and mission driven. They earn a fraction of what medical practitioners, doctors, surgeons in the human field earn. So those are kind of cumulative series of observations about the value chain that mean, I think, that in times of uncertainty or in times of distress, the value chain is sort of united by this sort of common mission or objective.
Interesting. We are having here in the chat field a former customer, or maybe I could also say short seller of the gym group. I'm not sure. His comments are a bit critical because he's also mentioning that they don't charge 18 per month, but they are charging 22 in the bigger cities and 15 in the outskirt locations. And he's also having critiques with the person who's fitting the gyms. It should be the brother of the founder, and that's a critical point for him. Do you want to react on this, or is this getting too deep for you?
No, I mean, all I would kind of say is that the point about pricing is that their average price is 17 or 18. Their average ARPU is 17 or 18. Like they are the lowest cost national gym chain. And I just think that, whether or not they're charging 18 or 25, they're not charging the 45 that the mid-tier gyms are charging for an inferior experience. I would say that, this isn't a business. I think that if you look at net promoter scores or customer feedback for gyms, it's generally terrible. And that is, and for gym, it's reasonable. It's not standout phenomenal. The negative feedback is usually associated with gym members leaving and being charged and being difficult to cancel their memberships. For example, for gym members who are tied into contracts. So there's a relative, it's not a business that is, universally extremely highly regarded by all of its customers, but I think that its relative appreciation is like pretty good.
Thank you. We are coming to an end with our live stream, and for the end, I want to give you the room if you want to mention one point we haven't discussed yet that might be interesting for the viewers and that describes you, Tollymore, or your view on investing in a good way.
Sorry, what do you want, Tillman?
You have the chance to add something we haven't discussed. So if you have a point that comes to your mind that's interesting for the viewers, adds value and gives insights, that might be interesting.
No, I mean, I just think that Tollymore at the minute is a one-man band, right? So I think that
I know that feeling.
Yes, exactly right. And and there are shortcomings. There are pros and cons of that. I think there's an obvious shortcoming in potentially the intellectual robustness of a process if you aren't sharing the work with people who are incentivized in exactly the same way as you. And I think that is a clear and obvious shortcoming. I think that there are lots of shortcomings of growing teams relating to generally complexity of organizational decision making that are underappreciated and not often discussed. And so, at the minute, I attempt to plug the intellectual robustness gap by being part of a intellectually generous community and having people like you to champion my efforts and to bring this sort of community together is a really important safeguard against that risk for me. And there's been ideas that have come into my fold as a function of these types of relationships. So I welcome people to reach out to you and reach out to me with feedback, with questions, or with observations or challenges. Bearing in mind the respective contexts and lenses through which we are trying to judge investment merits of companies. I think that we can play a small but valuable part in trying to create value in what is a very sort of institutionally focused active management industry.
And thank you very much for your insights and sharing your ideas. And thank you also to the audience for being with us and raising critical questions. That's always helpful because critic makes progress. And finally, I want to send you a hi from Dennis Hong. He's will be on here in, I think, 3 weeks, and he's sending you a nice hi. And I'm sending a goodbye to everyone who watched the stream and wish you a good night or day wherever you are.
Thanks, Tillman. Thanks, everyone. Appreciate the time.
Bye.
Take care. Bye-bye.
Oops.